Morning, and thank you for joining us for today's coffee talk. My name is Sean O'Brien, the president of QuickRate, and as always, I'm pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, thanks again, everybody, for joining us for our next rounds of Friday Coffee Talks. My name is Steve Huntington. I'm the Director of Analytics here at QuickRate and QwickAnalytics, and I've spent my entire career working with community banks all around the country.
Thanks, Steve. Also very pleased to be joined today by David Ruffin. David heads up our IntelliCredit division. David, you want to go ahead and introduce yourself?
Yes, always a pleasure joining with you. Normally, I'm on the quarterly update webinar we did a couple of weeks ago, but delighted to join with you. Obviously, I'm here to talk a little bit about credit and where credit may be emerging in terms of some trends and things that hopefully are pertinent to CECL.
Awesome. Thank you, David. Just a reminder, use the Q&A feature, the chat feature, and we will monitor those throughout the presentation, take the questions either in the midst or certainly at the end of today's discussion. Again, just a reminder, as David indicated, we thought today, I think as we've talked about a little bit this year, I think we're all, have successfully transitioned into a kind of a mode with taking care of and calculating our reserve. I think now we're really in the process of just again trying to optimize things and thought as we hit closing in on the final quarter of the year, just kind of look at what's ahead for credit and just again, as David indicated, some trends that might be emerging for many of us. We'll start today again with just a few polling questions, so certainly appreciate any consideration going ahead and answering these. Let me launch the first one. Have you undergone an audit of your reserves under CECL? So just kind of checking on the progress and status of that. So let's go ahead and just give this a little bit. And then there's a follow-up question to that as well. If you have, how have your auditors responded to your implementation? So kind of a double-barreled question there. If you don't mind taking those, we'll go ahead and give those a few more seconds here. All right, we'll go ahead and end this one. So 87% of the respondents have undergone an audit, and 80% of those have had positive responses, 15 mixed, and 5% a bit critical. So thank you for participating. Whoops, I didn't know if I shared those. Let me put those out there. There we go. And then again, we'll make these part of the email that comes out next week with the results of these. Okay, so let's go to the second question. Again, a little bit of a two-parter. First off, have you undergone an exam, a regulatory exam under CECL? And if so, how has your examiner responded to your implementation? So first one was with respect to auditors. Second one, more of a regulatory exam. So again, we'll just give this a little bit of time. Okay. All right, we'll go ahead and end this one. 69% have undergone one. 86% of those have been positive, 9% mixed, and 6% critical. So again, thank you very much for participating. For those of you who've had any issues, certainly reach out to us and see if we can be of any assistance to you. And then finally, just regarding CRE concerns, which of any of these commercial real estate subsets concerns you the most as we move forward here? So a few choices: industrial, warehouse, office, 1 to 4 family, multifamily, retail, and hospitality. So we'll just give this. Okay, we'll go ahead and end that one. Office is still, primarily the area of focus, 18% on retail, 9% multifamily, industrial, and 1 to 4 families. So again, thank you for participating in those, and we'll make sure, with everything, we'll send out a link to today's recording in an email next week with a copy of the slides and the results of these polling questions. So we have quite a few slides today, so we'll try to move through them pretty quickly. Again, just continuing to try to make updates and enhancements where we can. Again, the warm values import, I think, has been a nice add for those of you who are having us calculate your warms. Steve, anything you want to add here? Oh, you're on mute, Steve.
We pointed these out the last couple months since we implemented it, but just wanted to put them in the slide deck here to remind everybody that you can now, our tool will now automatically pre-populate your warms. If we're calculating your warms for you, as soon as we finish that process, not only will we send you the Excel files back, but we will also upload the results directly here. So you'll be able to click on that button, choose your methodology, and choose your date as of when we calculated them, and pull them up. If we're not calculating your warms, or if you just like to see some of the industry standard kind of values, whether it's coming from some regulatory guidance or whether it's coming from our thousands of CECLSolver user data averages, you can look at some peer-based warms as well and populate them directly into the tool to see how it would impact the results.
Awesome. Thank you. And so the other thing that, again, we've been kind of updating you on and continuing to try to expand is just some of the, information we get from our database of users. Here you can see what's represented with that, right? Over 325 banks using the CECLSolver. So again, it's providing us with a lot of, we think meaningful insights that we can share with you. Steve, anything you want to add here?
No, it's just to give everyone a feel for the size of the database. Obviously, this type of proprietary sort of internal data is something it's very hard to find. And now that we have such a good number of institutions using the tool, we felt like we had more than enough data to start working with it and sharing that data with our users. And whether it's to try to get some more insight into what your peers are doing at the segment level, right? Warm values at the segment level and Q factors and reserve levels at the segment level is not something that you can get from publicly available data. So we thought being able to share that would really not only give you some guidance to get started, but also help you in your defense and justification for the reserve levels that you're at, to make sure you're kind of within the tolerances and margins of where your peers are at. And we've shared some of that data I know it's been a really kind of a big spreadsheet that I kind of jammed onto the slides in the past. And we've added it to our knowledge base on the tool, but we're continuing to work to clean it up and make it more user friendly. So if you go to the next slide, Sean, right now, if you go to the knowledge base in our CECLSolver and you click on that CECL peer data, it's going to open up a new tab in your browser, which will bring you to the next slide. This. So instead of just shoving all the data onto one slide and then having just be medians, we decided to kind of organize it a little bit better. So now you can choose looking at warms or Q factors or collectively assessed reserve levels by segment, and you can see the trends over the last few quarters. Second quarter is available there as well. And you can click on 50th percentile or median is the default, but you can go down to 25th or up to 75th. And then you can click on any segment of the portfolio, and the chart on the right will update, so you can get a feel for not only where the average is for your for other CECLSolver users, but where that 25th and 75th percentile range are at the segment level, so you can get a comfort level that kind of flags some areas where you're like below the 25th or above the 75th percentile in reserves or warms or whatnot. Yeah, so we thought that would be a more helpful dynamic way to present that data. So feel free to go to the website now, and you can play around with this interactive page, and we'll continue adding more data and trends to it and making it even more interactive, and then giving you different ways to slice and dice that data as we grow the database.
Thank you, Steve. So, again, I thought we'd, with David being here, just, again, kind of talk a little bit about, just some emerging, credit, potential concerns, but just credit performance as well. So David, I'll go ahead and move the slides for you. So let's,
Yeah,
let you walk.
absolutely. Just thank you. In the interest of that, yes, I think I was having dinner last night with associate that had just called on a large bank, and basically there seems to be some dichotomy between loan growth. A larger bank client there told this gentleman that they really weren't interested in loan growth right now. That some of it was funding growth, funding issues, and what have you. But as you can see, there's a bit of a disparity. A lot of the community banks have had very robust loan growth in the last, particularly 18 months or so. And that sets the stage for, I think, the next slide or two. If you could move to that, Sean. We do have some, in terms of quality issues, we have really still primarily consumer purpose loans that are showing the highest degree of concern in terms of 30-day past dues based on the Fred data. Again, some of the business and more commercial still quite manageable in that sense. Next slide. As far as there is some C&I loan quality issues beginning to tick up, particularly with small businesses and smaller concerns. And then the next slide does give me probably the most concern, and that is from just a trending standpoint. And again, remember, everything we're going to show you is our QCBI base of banks that are 10 billion and under in their assets. So what we've done is regionalize some trends on loan quality, starting into the left with the non-performing loans to loans. You can begin to see a little bit of an uptick in those the last couple of years. Charge-offs are also beginning to tick up a bit, with the West leading at 16 basis points. But again, from an historical standpoint, I've been in the industry many, many years, that's still quite low compared to some of the heights we reached. Even it was normalized in the 80s and early 90s that 35 basis points losses were, we'll quote, manageable. We're way below that at this point. But also, again, this is critical to what I'm maybe wanting to talk about relative to CECL, and that is you begin to see some downward slope or flattening of the ACL among the smaller banks, 10 billion and under, bookended largely by the West at 150 basis points roughly, and the Northeast at 100 bips. So there's some disparity regionally from that. The next slide, which I tend to prefer in terms of looking at how much of your acknowledged inventory of problems is being currently covered by reserves. And as you can see here, that continues to go down with smaller financial institutions. That's not been the case at our larger. So the larger banks seem to be adding to reserves on the fear of particular CRE degradation. Community banks' reserves have begun to trend downward over the last year or two. And paralleling that is that larger banks' exposure in CRE, which is inarguably the one area that the regulators seem to be quite focused on in terms of loan quality, is declining at the larger banks, while at the smaller community financial institutions, CRE exposure is continuing to increase. So next slide. That again is an issue of just comparative sense, and and I know regulators see those same types of trends, which may put a little more focus on defending your reserves in light of these trends. I'll very briefly just kind of look at the kind of landscape of what we're seeing, as I already alluded to, the key macro metrics. These obviously would lead to your Q&E factors. They're still pretty good. We've still got issues on post-booking servicing, underwriting still very good compared to servicing, which is spotty. We've got some clear evidence of some credit degradation showing up as a result of the quick rate increases we started incurring a couple of years ago, and the inflation, and that's beginning to take a toll. We continue to see some bifurcated performance in our consumer borrowing patterns between the so-called paycheck to paycheck versus those with a little more healed balance sheets. There is absolutely no question we're seeing more downgrades in our loan review in the last 6 months. Most of those, fortunately, are downgrades, migrations within the so-called pass loan categories, but we have begun to see more and more activity kind of lapsing over into, to say, special mention, or even in some to substandard. I will hasten to say that most of the regulators have dusted off the focus on special mention. Remember, by definition, special mention is a transitory grade. Most regulators like you to park credits of concern in special mention for at a max 12, 9 months. They want it either to be reassessed and either go upward back into the pass categories or watch, or either or particularly more criticized as substandard or worse. We are clearly seeing that regulators are absolutely focused on a lot of two things primarily: your credit processes and your your CRE, and how you are defending your exposure. Disproportionately, again, impactful at the smaller bank level, because the smaller banks are the banks, frankly, the only financial credit providers in the entire United States economy. They're growing their CRE portfolio. Every other provider of credit, all the way up to the top of the house, which is the most sophisticated CMBS, REITs, and things of that nature, are lowering exposures to CRE. Small banks, community banks are the only ones growing it. It's just inevitable that that's going to put even more of an impetus on our banks at that asset size to defend their strategies for growth in that, and also how they're managing that. And in that sense, next slide, please.
Yeah, David, just if I could interrupt you and just ask a question.
Yes.
So in your loan reviews, what kind of impact is the rise in interest rates having on loan grades, or what with refinancings? Have you seen anything that's been noticeable?
Absolutely. We've got, as you see in this slide, you've got an estimated $1.5 trillion yet to be repriced until the end of next year. And repricing obviously has a downward drag on debt service coverage ratios. So we're beginning to see that. In fact, it's in our loan review work, it's beginning to lapse out of tolerances in terms of banks' policies or guidelines around debt service coverages. That's clearly the case in some of the SBA portfolios. As they've begun to reprice, we're beginning to see significant impact on debt service coverages that with much lower rates earlier compared to where they are today. So that's the biggest issue. The cap rate issue, of course, is a valuation issue. So as cap rates rise, but again, I just want to reiterate, this is an example of where the CRE exposure to community banks may not be problematic per se, because most bankers seem to be quite comfortable with their quality and how they're managing it. But again, it's just, the reality is that if you look here, unfortunately, the federal regulators aren't as quick as QwickAnalytics is to get call report data scraped and analyzed. So we're going back here another quarter with the FDIC, but you can see the disparity between the loan growth and CRE between the big banks and the smaller banks. Okay, next slide. Here's the real crux of the advice I can give bankers right now, particularly as it relates to CRE. It's like two halves of the same walnut. We all, I think, are fairly competent and know in our sleep how to underwrite a borrower and a project. That's not really a concern of anyone's, whether it's loan review or a regulator. What is concern is the other half of the walnut, which seems to be the total focus of the regulators right now. And that is, okay, we get it. You're underwriting your loans, you're underwriting your CRE projects. Now, what is the supply and demand nature of the footprints by which you're making these loans? And if banks are caught in the deer in the headlights on that issue, or look very superficial in their understanding of their various marketplaces, and I don't mean just in a general sense, I'm talking about corresponding every single subset of your CRE portfolio into its own supply and demand dynamic within the footprints that you're lending into, So that's the one area that seems to be embedded in so many of the MRAs and the regulatory actions and criticisms that we're seeing right now out there in the industry. So be sure you embrace that sense that CRE now is two halves of the same walnut. All right. Again, these are some of the things that I would think are very, very important to kind of look at, improving your analysis of those subsets, taking advantage of improving your MIS data, making sure your policies are up to date. Don't be relying on 5, 6-year-old policies. You know, several bank clients even had 3, 5-year interest only CRE structures. That's just not going to cut it right now in the current sensitivity about, particularly from the regulatory perspective. We're huge advocates of use of multiple stress test modes, and thank goodness IntelliCredit has now come to the fore, and we finally got our loan level to basically partner with our sister division, which has an excellent portfolio level stress testing. But again, multiple is better. One size doesn't necessarily fit all. We certainly think loan reviews, this is not the time to cut back on that. And this is, again, one of the patterns we're seeing with the regulatory criticisms, is that for even in certain banks where at mid and upper levels of credit management, they're doing a defendable job in understanding, somehow it's not translating to the board of directors. Because that's where your strategic plans are, your risk appetites are, and consistently I see in the sense of that being discerned by the regulatory community as being adequate or not. It's around a lot of that. Does it show up in the minutes? Does it appear to be an agenda item in the board of directors?
Yeah,
So,
and yeah, David, I interrupt. I would follow that up. I think if you go back to coming out of the financial crisis, particularly when we developed our portfolio level credit stress test, that was really one of the mandates, if you will, from the OCC, was that this really needed to be a board driven, type of exercise. So to kind of echo David's point, if you're doing the good work of conducting and utilizing stress tests, again, whether it's at the portfolio level, that we have in QwickAnalytics, or now the loan level that David has with IntelliCredit, or some combination of the two, it's imperative that is communicated and made aware to the board, because that was the single biggest thing that the OCC wanted, was to make sure the board understood what management more inherently understood, which is what the risk level was of the loan portfolio and what that capital cushion or potential risk looked like. And so as David said, to not communicate that effectively with your board is in some ways minimizing the good work you're doing by conducting the stress test. Sorry, David.
No. I think that's well worth emphasizing, because again, I was privy to a conversation just literally yesterday with a bank that's under a Federal Reserve issue about that. And that point was the Federal Reserve said, well, you've done so well in even improving what we still want to see is more dynamic discussion at the board level, because they think of it in terms of things like sometimes boards do, strategic plans only 2 or 3 years, they update them. This is real now. Things are changing, in particular the CRE world, much more quickly than 5 years, right? Or 3 or 5 year installments. And they want even issues like how often do you link your concentration performance to capital plans, like if indeed you have further degradation, which I know Steve Huntington does a tremendous amount of discussion about what is the, into even a portfolio level stress test, what's the impact on your capital. They want to see almost a real-time sense at the board level that is, if we're pivoting into some more credit stress in CRE, what does that instantaneously do to a potential capital plan to give us more cushion against possible degradation in that area? Again, many of you have heard me say this. Much of the IntelliCredit mission is to try to merge these 3 very critical steps in managing credit risk, which is portfolio analytics, make sure and smaller banks still aren't quite where we need to be in terms of realizing the incredible wealth of the DNA, that the loan data that we sit on. We like to think we can help provide some of that, but also utilize whatever tools you have to slice and dice, identify emerging hotspots, make sure that's all done before the regulator kind of points it out for you. Again, stress testing, we're big advocates of using a blend or a hybrid of that between portfolio and loan level, and even companioned with loan review work. And then as it relates to loan review, again, this may be somewhat self-serving from our end because it's our philosophy. We only use very seasoned reviewers to do your loan review. I would advise any of you that use third-party loan review vendors to be sure you're asking for bios. Know who is out there looking at your credit. They are an agent of your bank, and in particular in some degree of heightened credit stress, you've got to hope for the fact that your agents, so to speak, are doing a good job. You want them to be the first to detect that before it gets to a regulatory scrutiny.
Thank you, David. That's fantastic. Again, I think, as David indicated, right, I think, certainly a little bit of a change in I don't want to say, just kind of the landscape of even loan reviews, right? Just with the impact of higher rates and just certainly concerns from the regulatory body that, you probably will see an uptick maybe in exceptions or just, risk grades being challenged or revised. So just keep an open mind that your loan review partner is on your side, because you want those things to be, detected through your loan review, not necessarily have an auditor or regulator find them, behind you. So recognize the role they're playing. Again, all designed to keep you in the best position possible. So Steve, I think we'll let you kind of take over here a little bit. We've got a couple of different things that we can talk about. Just around validations and just the stress test. So anything you want to kind of jump in?
Yeah, I kind of wanted to start with that first slide
Yeah.
that just has a so if you go head back up, yeah, right there. I'm just going to share my screen for a second and kind of walk through this. It's a question we get pretty commonly from our CECLSolver users that are kind of just trying to eyeball some of the numbers to make sure, instead of doing like a full-blown validation of a tool, they're just maybe presenting the data to their board and they're trying to get to some of the implied CECL calculations from the inputs that are on the summary page, and they're finding that there's some small errors or the numbers aren't perfectly matching up. So I wanted to spend just a quick minute showing you guys how you would go about doing that to avoid any concerns. Let me share that screen there. All right, so I'm gonna paint a quick picture here for everyone. We're using our guinea pig bank for today, and I pulled up a new scenario. And let's say we're focusing on C&I loans. A common question we get is, all right, I'm done with the entire scenario, and I plugged all my data in, and now I'm trying to recreate this $1.196 million here reserve level. And we can see how the math is supposed to work. Your historical rate plus or minus your Q factors equals your expected future loss rate. And then we apply that loss rate to our current balance, and we should get the CECL amount, right? But if you keeping in mind here that the values that you see on the screen, some of them are rounded, right? They're not exact values. They're rounded to significant levels of digits. So if you were to take 36 basis points and multiply it by, so your expected future loss rate of 36, and multiply it by that current balance, you're going to get something that is, I figured I would do it right here, 0.0036 times 336171. 1210. So instead of 1196, which I expected to get, I'm getting 1210. Not a huge difference, but obviously not exactly on point. And the reason for that is the historical lifetime loss rate is not exactly 36 basis points. If we were to want to kind of go through the math real quick to get an exact value here, so you could perfectly come to this same result yourselves, right? To get more comfort level with the math, If you head into the historical analysis, you'll see all the details right on this tab that can get you to that exact value. So if I scroll down here to the loss rates, I'll see that for C&I, I'm using 2.95 years as my warm. This is my look back period, right? Here are my loss rates for each individual year. Here is the loss rate over the entire look back period. And then I have a slight change due to a discrepancy between the warm and the look back period. And what that means is our warm is 2.95 years, but we're using 3 years worth of data to our look back period is 3 years, which is about as close as you can get to 2.95 using call report data, right? That comes out quarterly. So what you do is we take the actual net charge off amount. So we add up the net charge offs over the look back period, a 3-year period. We get 1.236 million. That's our numerator, right? For a net charge off ratio, 1.236. And the denominator is the average balance, right? The average balance of C&I loans over that same 3-year look back period. And if I scroll up to the top here, I'll see here are my balances. Here is my average balance over the entire look back, that 3-year look back. It's 341,591. So if I take 1,236, divide it by the 341,591, I'm going to get close to, rounded to 0.36, but more like 0.36142, et cetera, et cetera. Then I would take that value and multiply it by the look back, the lifetime look back multiplier, because this is my loss rate, my total losses over 3 years. But my warm is 2.95 years. So I have to take that 0.36, et cetera, and multiply it by 2.95 over 3, or approximately 0.98. And that will get you to the exact value, which is close to 0.36, but not exactly. And so if you take that exact value and come back here and multiply it by your balance, you're going to get exactly 1.196. So kind of wanted to just go through that because we've gotten a number of calls from institutions who are trying to just use the math on this page with particularly with this rounded number and maybe a rounded multiplier to get exactly this number. And it doesn't quite work that way, but it is very close. Another quick way to do a quick validation of it is to go backwards. If you take this 1.196 and divide it by your balance, you're going to get something that rounds to 0.36. So there's a couple different ways that you can use the other data that's in the tool to get you to exactly this number so you can get comfortable with it, just so that you know there's reasons why the values just on the summary page don't always round to exactly 1.196. Stop sharing that screen. I think that's all I wanted to point out there, Sean, if you want to get back to the presentation.
Let me grab that back here. Okay, next up, just talking a little bit about some of the additional data that's available to you, particularly when you're trying to think about severity through the interactive stress test. So Steve,
yeah, so the idea here is this, I'm not going to go into too much details about this interactive credit stress test. It's an entirely different tool that we have in our toolbox at QwickAnalytics that you all have access to as subscribers. We are going to be doing a webinar. See how I get that in there, Sean?
Yes.
In the very near, what next week?
Next week, yes.
Next week, we're doing a webinar specifically on the interactive credit stress test. So I'm not going to get too far down the rabbit hole today, but suffice to say, the purpose of this type of stress testing is to do a bunch of what if analysis, right, around your portfolio and looking at different levels of stress determined by historical performance, right? So kind of answering the basic question, if my loan portfolio over the next couple of years, if it were to perform, say, like my peers did during the last credit cycle, what would be the impact on my P&L and my capital? So it is completely reprojecting your earnings and your capital levels over a 2-year time horizon under varying degrees of stress as determined specifically by past performance of your institution and of your peers at the median level and at much higher loss levels like 75th percentile losses or 90th percentile losses. but how that data could be helpful, or at least parts of it, even in just defending or looking into loss trends and considering reserve levels under CECL, is specifically looking at the peer data. So go to the, actually, you can stay here for 1 second. On the input part of the tool, you can choose a peer group, and you can choose a look back period, and then you can play with the severity of losses. So you can see, all right, my peers of, let's say, 100 to $600 million community banks in Alabama, and I want to see how they performed during the last credit cycle. Maybe not over the last 3 or 4 or 5 years or even decade, but more like 2008, 9, 10, 11, and 12. And see exactly how bad it got, maybe at the median level, maybe 75th or even 90th percentile losses for any custom peer group that you want. So this is I mean, this sounds like similar data to what we already have in the CECL tool when you go to the peer data tab, but it is significantly more flexible in the way we present it. And it's going to be something that we're going to be integrating into the CECL tool directly in the near future. But right now it resides as part of a stress test. So why don't I go ahead and share my screen again, Sean? And there's a screenshot of it, but better to do it interactively since it's such a. All right, go to share. All right, so I'm gonna head over to the stress test. This is something that any of you can do. You already have this as part of your of the platform. As soon as you open up the stress test, it all is kind of run in the background already with some basic assumptions. But where we're trying to go right now is head to the inputs, and then head to peer historical loss rate analysis. We have baseline scenarios, which are kind of recent healthy environment with a lot of zeros and losses. But the helpful part of the data here is really in the stress scenario. So if I click on that, I can choose, let's say, my standard UBPR peer group or my state-based community bank or any custom peer group I want. For today, we'll just stick with the national UBPR peer group 3. And you can see these loss rates are for all the same segments of the portfolio that we use in our CECL tool. And we have a slider here where we can literally click and drag. And as we change the look back period for the portfolio, all these loss rates are recalculating on the fly. And what I mean by that is these are 75th percentile loss rates. So by default, we use 75th percentile. That's how we determine or define our adverse stress scenario, and our aptly color-coded blood red severely adverse scenario, it defaults to the 90th percentile loss rate, which is certainly a worst case, or maybe even probably even worse than a worst case scenario. But you can come here, click on the adverse scenario, take a look at your peer group's loss rates over individual years, and then maybe do an average over the entire stress period. And if you want to make it more punitive, you can come in here and say, you know, well, first, let me just see median loss rates. Type into 50th percentile. Every single value on the page, not just this calculation here, but the entire page, everything recalculated to be median or 50th percentile for the loss rate for each segment for each year for the peer group. And if I wanted to, let's say I want to add a little bit of stress into this situation, maybe bump it up to 60th percentile. I could do that across the board. Maybe I want to do 60th percentile, but I want to be more punitive on some of the CRE loans. I can come in here and for the non-farm, non-residential, let's say I can bring that up to 75th percentile, bring those up to 75th, construction 75th, and multifamily. So if I change some of these CRE related loan segments to 75th, then every value just in that row, right, just for that particular segment goes up to a 75th percentile loss rate. So this is a way that you can sort of dial in and customize and add a little bit of stress into the historical loss rates on an annual basis, right? That your peers experienced. And then you can take some of that data and translate it into justification or defense for qualitative factor adjustments from a CECL perspective. So right now, while this table and sort of interactive design lives only within the stress test, it's already accessible to everybody. And we're going to try to kind of extract it out of there and make it more accessible throughout the platform. So whether you're like this type of data when you're working with CECL and considering reserve levels, you can use it there as well. Sean, anything I failed to point out on that with that functionality?
No, I think it's great. I mean, again, I think one of the things that I think, we certainly get asked about, and I think, I think we all kind of grapple with, right, is, particularly when we're looking at subjective things like Q factors, we really want to make sure, we've got something reasonable in there. Sometimes we maybe want to be, more aggressive or less aggressive. What we like about this and why we want to incorporate it into the, more plainly into the CECLSolver is the ability, as Steve was demonstrating, to what if and just kind of see what range of losses banks actually experienced in severe times of stress, can give us a sense of what might be reasonable to try to build our Q factors to, or just that's objectively stating what kind of net charge-offs people saw. So again, we just think this is again really relevant excuse me, and informative peer information that obviously really kind of energizes and is the energy source for our stress test. But we think there's there's relevance and applications for the CECLSolver as well.
Certainly, and the ability to consider multiple peer groups in a very dynamic sort of environment, where if you want to take a look at what your peers experience at the national level, then you want to zoom into the state level, then you want to zoom into the local level and have a tight asset range. You can almost instantaneously toggle between different geographies and peer groups to get a feel for, again, the range of losses that some of your peers at different levels have experienced, maybe not recently, but during the last credit cycle. So if you're kind of playing with or bouncing back and forth when you're doing your CECL calculations for, how much of these losses am I trying to capture via maybe, my own historical data and having a super extended look back period, right, for my historical loss rate versus, I just don't feel comfortable going back 15 years in my own losses. So that means I'm probably going to have to incorporate some more qualitative factor adjustments, and I can utilize this type of stressed losses at the peer group during the last credit cycle as justification, maybe for beefing up a qualitative factor adjustment and environmental factor, as opposed to spending so much time, turning the knobs on your own historical experience to try to find the losses that you feel like your reserve, your ultimate total CECL calculation needs to pass regulatory scrutiny.
Well,
that's right. And go ahead, David.
No, Steve and Sean, I wanted to add, if you accept the premise that I was speaking about in terms of the aggregate trends of 10 billion and under banks of actually growing loans, growing CRE, and lowering reserves, and there has been a bit of an uptick, nowhere near like the last credit cycle. We certainly understand that, but there is an uptick in both NPLs and some charge-offs, not materially. But this what if scenario gives you the ability to maybe at least begin to show some marginal increases in your Q&E factors to frankly say that you are aware of these things, and therefore showing at least not to necessarily re-emulate or try to protect yourself against the financial crisis era, but just you're on top of the current trends.
And that's an excellent segue, Sean. You go ahead and
well, I was going to say too, and the other thing is that I really like our peer data tab in the CECLSolver, but they were looking at an average for a peer group, and so I think as Steve and I were talking about this, I think one of the things that we felt like we should add more to is the ability to look at that peer group again, whether it's a UBPR, whether it's a state or it's a local one, and not just see the average, but really drill into a percentile and see what those numbers could look like. So again, we just think more visibility into the peer data can be more substantive if you're trying to utilize that or as one of your Q factors.
Yep. And I'm going to go ahead and stop sharing my screen so we can move forward on the slides. But what David was just saying is a perfect segue into the next couple slides, because we're going to show here that, and this kind of dovetails with what David has been seeing with on the non-public side. On the public side, if we head to the next Yeah, so these are some industry credit trends that come directly from the call report data, brought from QA. And what you're going to see is that exactly what David was just saying, where reserves have kind of flatlined and dipped slightly maybe for community banks, while at the same time we're starting to see a bit of an uptick, not huge, but certainly on the increasing side as far as past dues. And so we see here, this is 30 to 89 days past due. This is for, I just randomly picked, not randomly, but picked UBPR peer group 5, which is obviously the gigantic, 1,200 banks or so in the 300 million to a billion range. And I just kind of red boxed some of the trends that are kind of obviously going in one particular direction. So I showed median values and we showed 75th percentile, because when we're looking at loss rates or when we're looking at asset quality at the segment level, most institutions, they have, very good asset quality for most particular segments, and one segment or another ends up being what their issue is. So when we're looking at medians and percentiles, they tend to be kind of low at the segment level. But you can see here, 1 to 4 family residential came up some and is kind of not seen much increase over the last couple of quarters. However, non-farm, non-residential, maybe not at the median level, but when we start looking a little bit towards the margins, right, of a 75th percentile of past dues, 30 to 89 days past due, that's the first time where we can get it and see it on the call reports. We see a market increase from 19 basis points a year ago to 35 basis points in the second quarter or as of June 30th this year. So not high from an absolute standpoint, but very, very obvious and clear from a trend standpoint. Same thing with C&I loans, and the same thing with consumer loans too. Even at the median level, consumer loan past dues have increased about 50% over the last year. Now that's 50% on a historically low value, but certainly the trend in that direction.
Yeah, and I think, and Steve, I think, and Kyle, quoted in the chat, just again, being able to move away from the average or the median just really does give you some additional insights. And I think that's really kind of what our catalyst here is, to just better unlock some of this pure information that we have, which we think, again, can be a bit more informative.
Yeah, I mean, segment level medians are like the last thing to show emerging trends, just because of the way the math works when you're calculating a median for a particular segment of the portfolio. You see lots of zeros. So you want to look a little bit towards the margins, or maybe do some weighted averages as opposed to just medians, or look at 75th percentiles, and you start to see some of those trends better. That'll be even more apparent on the next slide. 30 to 89 days gets some more values, whereas non-accrual loans, if we look at medians, we see a lot of zeros, right? Except for maybe a little bit on 1 to 4 family. Other than that, the medians are pretty zeroed. However, once we start looking at that 75th percentile, we see that even 1 to 4 family residential, slight uptick in the second quarter, highest it's been in the last couple of years, but still not that high. Non-farm, non-residential, significant increase from 31 basis points to 57 basis points at the 75th percentile. And then same thing with C&I, and a little bit, not much, but a little bit of a consistent uptick in consumer loans at the margins. So
and again, so just to further reiterate the same point, here again we're looking at UBPR 5, and so again, going to the 75th percentile unlocks some information. We think then further narrowing that funnel, right, to either your state or to even a more local custom peer group, and having the ability to extrapolate out to a percentile, again, just can potentially, again, unlock even more insights.
And that's going to be, and that's some of the things that we're working on currently. Is I know we just showed you guys the way our stress test sort of dynamically plays with the peer group and the loss rates, but being able to look at that data and visualize it any way you want, and not just look at net charge-offs, but look at past dues and non-accruals and play with the percentiles, is something that we're going to continue to develop as we move along here. And then the last one, so you notice I'm kind of working my way down the migration, starting with the past dues, getting to the non-accruals, and now finally to the charge-offs. This is where, at the end of a line, you're going to see the most zeros at the median level. So I'm not even looking at the median. We got 75th and 90th percentile are our two options right here. Even at the 75th percentile, lots of zeros. But on the margin, at the 90th percentile, we're seeing a significant, we're seeing an increase in charge-offs. And As we all know, there's a bit of a seasonality or a cyclicality to charge-offs here, where people tend to kitchen sink things at the end of a year. And so while looking at when you're looking at trends over time, I like to kind of look at the same quarter last year versus the same quarter this year. So that's why I kind of highlighted C&I 38 basis points in the second quarter of last year at the 90th percentile. Second quarter of this year, 63 basis points at the 90th percentile. And not as much of a pronounced, but also an increase on the consumer loan side. So we are seeing at the margin some crack in the armor, so to speak. In while we're not seeing any additional increases at all in the reserve levels to account for these yet, because the average community bank is not seeing these yet, but they are at the mark. They're starting to at the margins. This is something we've shown a bunch of times. I just felt like I had to update it again for this quarter. This is about the unfunded commitments. We get lots of questions about the unfunded commitment calculations, and some people have gone far down the rabbit hole, either for their own sake or because they've been kind of required to from an examiner, or probably more likely an auditor. But we wanted to share these statistics. The percent of banks that are establishing some level of reserve for their unfunded commitments was very low before CECL came out. It was already a line item on the call report in the other liabilities section, but it wasn't very heavily calculated or utilized. Once CECL came down the pike, there was a bit of a renewed emphasis on having to take the unfunded commitments into account from a reserve standpoint, as opposed to just maybe throwing a little extra into the contra asset account. And so that's what we've seen slowly, very incrementally. We've seen, from more than half of the banks in the country not reporting any reserve on the unfunded commitment on the liability side of the balance sheet, down to 40% are not reporting it. So 60% of community banks, the majority now, are reporting a separate reserve for the unfunded commitments. And if you just look at the unfunded commitment reserve as a percentage of total reserves, total unfunded commitments in the industry, you're not going to get good data, because that takes into account the fact that half the banks aren't reserving anything for it. So you kind of want to remove them from the calculation and say, hey, what are the median levels of reserves for unfunded commitments for the banks that are actually doing a reserve for unfunded commitments? And that level is staying very consistent at about 30 basis points. So 30 basis points reserve for unfunded commitments as a percentage of total unfunded commitments for that 60% of banks that are actually filling it out. So the level 1 data would suggest the reserves are increasing for unfunded commitments. The level 2 data suggests that there's more than meets the eye there, and it's actually staying pretty consistent. And this I did not get a chance to update yet for the second quarter, but we only shared this one time, so I just wanted to see, and this is something we're going to be updating in the future. And funny, it just happens to match exactly what what David's chart from earlier showed, that there's a significantly lower reserve level up in the Northeast region of the country versus the rest of the country, with the West leading the way in reserve levels and Northeast having just under 1% on average or median. This is for all the community banks in the country. And so I just thought I'd share that. Well, I'll update that next month for the second quarter. You're muted. Oh, there.
Yeah, thank you. Thank you. Appreciate that, Steve.
Sure.
Excuse me. So if you have any other questions today, go ahead and submit those. Just a reminder, as Steve indicated, we've got some webinars coming up in the next few weeks. All of our historical ones can be found on the YouTube link. You can see at the bottom of the page. We do have, for those of you who have not taken us up on our offer for the Portfolio Analyzer, we do offer a 6-month free trial on that product, primarily just to be able for us to demonstrate to you its value. We don't expect you to take our word for it, but we think we'll be able to show you, A, how quickly we can get you up and going, B, or 2, how quickly we can educate you on how to use the tool, and recreate, the reports you might be utilizing in the bank today, or add additional report capabilities. And then thirdly, just to that point, further show you how much more, as David talked about, you can really capitalize on your loan level DNA, and have a better sense of any potential changes or migrations or emerging trends, appearing potentially sooner than it's going to show up in a call report. Next week we have kind of back-to-back webinars. David's going to do one discussing loan review and your strategy around loan review, and if yours is currently adequate. And then secondly, all three of us will be back on to talk about stress testing, where we'll discuss not only the portfolio level tool that's available in QwickAnalytics, but David will talk about the companion stress testing, or the standalone service stress testing we're doing at the loan level in added telecredit. So certainly encourage you to register. You will get a copy of the slides and a link to the recording if you can't attend, but certainly go ahead and register for those coming up next week. We'll be back in September for another coffee talk at the end of the month. And I don't see any additional questions. Steve or David, any final words before we let everybody off to their Friday?
No, thanks for having me attend. Look forward to next week's discussions, and everybody have a great weekend.
Yeah, my kids are just going back to starting back at school, and fall is approaching. So if I look a little frazzled on next month's coffee talk, you'll all understand why. I've got a boy starting high school and another boy starting middle school. So
all right.
Prayers would be appreciated.
Good luck, Steve.
Thanks.
Okay. Well, thanks to David and Steve for joining us. Thank you for taking time out of your busy day. Have a great weekend, and hopefully we'll see you on a webinar next week. Have a great weekend, everyone.
Thanks, everyone.